So the purpose of this panel is to discuss this assumption that the returns of litigation finance are uncorrelated with the market, and this is oft repeated and seems to be one of the most attractive things about this asset class to investors. Before we get going, I'd like to ask the panelists to just briefly introduce themselves, and then we'll go from there.
Sure.
Excellent.
My name is Chris Malloy. I'm a finance professor at the business school. I teach the investments course, which is a second-year class for MBAs, and we have a class on litigation finance. So it's a 28-session course. The last 5 or 6 days are on niche asset classes, of which we sort of have a full day and a half on litigation finance. And I also teach courses in fintech and behavioral economics.
Good afternoon. I'm Andy Wolfman. I am the co-founder of Statera Capital, which is a relatively new entrant into the commercial litigation finance space. We're Chicago-based. We launched late last year. I was a litigation partner with McGuire Woods for the last nearly 14 years, and my partner was the CFO of a public marketing agency in Chicago called Inner Workings, and I'm very happy to be here today. I think this is an important topic.
Hi, I'm Lee Drucker. I'm a co-founder of Lake Willens. We've been around since 2013. I'm based in California, and we also have offices in New York.
So since we do have a couple students in the room, and we're recording this and hope to share the footage with students going forward, could you explain why it is attractive for an asset to be uncorrelated with the market, and what exactly that means, and why it is likely that litigation finance falls into that category?
Sure. So when you view it from an investor's point of view, we always think an investor wants an asset that has a high net return and low volatility when you think of an individual asset and an individual asset class. But when you think about putting it into a bigger portfolio, what people really care about is having a high net return and then low correlation. And this asset class has all the natural properties of that. If you view it as a stream of essentially coin flips on outcomes where the payouts are determined in some sense randomly, the timing, it's very attractive from that point of view. And that's why a lot of interest in finance has sort of shifted into this space. It's also why a lot of capital may be moving into the space, and that's an issue we can talk about in a little while.
And from the funder's point of view, I mean, since you've been in the business for some time and have observed it, does it seem that the returns and the interest are relatively unrelated to the market, or have you seen money coming in certain times and fluctuating returns and kind of investments, both sides?
I'll say from a newer entrant, and Lee's been in the space for a long time, I think it's an important conversation because I think there's a lot of talk about this being an absolute uncorrelated asset class, and as far as I know, there are no empirical studies to support that. There's been a lot of studies about litigation trends in up and down economies in certain practice areas. But as far as this asset class's performance, partially because it's new and partially because there's limited access to the returns, as far as I know, no one has done a comprehensive study either here or abroad over the history of it. And so it's interesting that everyone speaks of it in almost such an absolute term. And I think, as we speak a little further, I think it's a bit more complicated than the sort of first blush assumption.
Yeah, I think, uncorrelated can mean a couple different things. So the question is the equity value of a litigation funder uncorrelated to the broader market? So if you invested in Burford stock or Bentham stock, is it going to be subject to the ebbs and flows of the broader financial system? I think that's largely unproven. Again, I haven't run a regression analysis on it, but Burford was started in 2008, I think. Has basically gone rocket ship direction up, but also the economy sort of, in my mind, looks like it's taken a similar trajectory. So I think, we'll see in the next downturn. Bentham, I'm not as familiar with their performance, but I would guess that it ebbs and flows along with the Australian stock market, and it's included in a number of different indexes, so people probably buy and sell those indexes, and that causes the price of Bentham to go up and down as well. But that, I don't think, touches on whether the underlying asset, the funding of the claims themselves is uncorrelated. And for that, you'd want to look at, does the stream of cash flows change based on where you are in the economic cycle? And again, this asset class being so new, I don't think we've had, and also opaque, I don't think we've had the data from the return side or the, enough of an arc to the economy to know, if or how much the returns are correlated with it.
One of the things that we had discussed before we came here was that it may be difficult to collect in a market downturn, and that this, for better or for worse, is going to force you to correlate with the market just because you won't be able to collect. Is this an actual problem? Or are there things you can do kind of in the due diligence process to mitigate that risk?
Yeah, I think, if you talk about individual pieces of litigation, there's uncorrelated aspects and certainly correlated aspects, and, there's idiosyncratic risk in every element of a piece of litigation. Theoretically, in a single case, how a judge or jury decides on the matter of liability or damages should have absolutely no correlation to what's happening in the broader economy. But when you go a step further and you look at settlement decisions, which affect, obviously a far larger percentage of cases and execution on the back end, all of a sudden, macroeconomic factors do come in. And so, these are things that, yes, we do look for in the diligence phase. I mean, obviously, and I missed the first panel. I'm not sure if it got into it, but the duration and the execution opportunity on the judgment is a relevant consideration, and certainly the factor, the market plays a factor in that. But, again, it's, have we seen patterns through a down cycle inside of these funds as you group together and construct a portfolio of these cases? I'm not sure.
One approach to trying to dig deeper into it, just because this is a new asset class, is to see if there's anything else out there that has kind of an uncorrelated characteristic. Merger arbitrage is something that we had discussed. And maybe if you want to jump in and kind of explain if there are any similarities or differences to that asset class and litigation finance that could help us answer this question.
Sure. I mean, just stepping back for a second, this discussion reminds me of, I had a college roommate who was a Marine, and he said that the whole purpose of military combat throughout history was to get further and further away from your opponent. So it started with like a sword, and then it's a bow and arrow, and then it's a gun, and then it's a missile, and then it's a satellite, okay? And I view asset management has a similar dynamic where one of the byproducts of asset management is you get further and further away from like the core asset class, as Lee mentioned. And so like, when we think about this discussion, since we don't have a big history to look at, there's just no data out there, there's not a big time series. The best you can do is sort of look at other asset classes or look at sort of similar situations and try to figure out how close is an investor to the actual asset class from the thing they buy. As Lee said, you can buy Burford stock, but of course then you're going to be correlated with the market. You're just going to inherit whatever market correlation they have. So there's that. Then there's like one step further, which is let's just think about the economics of recoveries and settlements, and could they be correlated with the market? And I think you could for sure tell a story where recoveries have a pro-cyclical component, right? I think it would be good anecdotally to sort of hear about some of those stories. But then the next stage over is to thinking about funds and fund structures, okay? And this is a really important point that I've seen anecdotally in my own investing in this area is, let me give you an example. For example, you invest in put yourselves in the shoes of an investor, right? And you invest into a fund, and that fund does a bunch of things, one of which is litigation finance. But 80% of what they do is other opaque asset classes, okay? And then that fund has to be levered because they want to juice up the net return, okay? That leverage, of course, is a variable interest rate, okay? So as interest rates go up, that levered fund gets put under pressure, and say they have a shock in one part of their portfolio, totally unrelated to this litigation piece that they're really good at, okay? They're going to lose a bunch of money, they're going to get a bunch of redemptions, and then they're going to have to sell. right? And if the redemptions are big enough, they're going to sell everything. And then you have to sell these claims, and then that sells into a secondary market, which is growing in this area, but it's not a hugely liquid market. And that's a situation where then you could take a discount and take a hit. And so there it's the situation, it's the structure of the fund that induces a correlation into this asset class that on its surface has no relationship to the market, right? And so I think it's like useful to think of situations like that. And then another one we had in my class last semester, we had a fund manager come in that was a fund of catastrophe insurance. This is literally a fund betting on hurricanes. I mean, completely idiosyncratic events, okay? But their fund was structured with very favorable liquidity provisions for their LPs, right? So, turns out in 2008, although there were no hurricanes and their fund did completely fine, the fact that everyone was allowed to redeem from their fund meant that their LPs, who were taking shocks from something else totally unrelated to what they were doing, they just looked at their portfolio and they said, oh, I'm going to withdraw from that fund. So they withdrew from that fund, and then they had a huge negative NAV shock. And so again, it's sort of like when you think about the spectrum of the asset class versus sort of how you have to invest in that asset class, I think that's where you want to think about, could you as an investor be inheriting some correlation that like you weren't expecting at all when you went into it?
I think from my perspective, which is kind of as close to the asset as you can get, I think you can structure it in a way that you're more exposed and ways that you're less. So for us, we really only invest where we're the counterparty to the litigation is a very well-heeled company that our portion of damages or the damages that are at issue is such a small percentage of their revenues, equity value, whatever it is, that unless there was a situation where 50% of the publicly traded companies went out of business or 25% of the publicly traded companies went out of business, we would be fine and doing well, assuming we accurately predicted the outcomes of the litigations or arbitrations. The other thing that you could do, we don't do, probably doesn't exist perfectly and can't do yet, but because you are fundamentally investing in the outcome of a litigation, not on the financial health of the business, and there's other investors out there that are really great at understanding and valuing and investing in the ultimate value of the business, you could bifurcate the two, right? You could make an investment where if you win $20 million, and then you buy insurance that company is going to stay alive, for the next 10 years for $2 million. Now you've kind of separated those two parts of the investment. So I think, to get back to the question, I think fundamentally the outcomes of a legal process are not in any way, in my mind, attached to the gyrations of the economy. And so as you get more sophisticated on the front lines, you should be able to kind of create something that is very uncorrelated to the broader economy. But to everyone's point on the panel, I think there's lots of ways that you could still be correlated.
So that piece of only investing in opportunities where you know that there's a deep pocket and so you'll be able to collect means that it makes it very difficult to invest in smaller lawsuits or lawsuits with smaller defendants.
Yeah.
But that is a whole huge portion of the market. Like the whole mid and small size portion of the market goes without attention. Do you think there's a way to invest in those kinds of lawsuits nonetheless and still be able to collect and return to your investors?
I think that's a nut that a lot of folks are trying to crack. There's other issues with it besides. I think if you underwrite, if you price steeply enough, if you do all sorts of things, you could probably still get uncorrelated. I don't know, but there's so many other inherent issues with diving into that part of the market. People are trying to figure it out. I think the main issue is the amount of skill and work that it takes to underwrite a claim makes it such that it's only economically viable to have a business that does that for ones where you can make a lot of money. If there's a $50,000 claim, the amount of you're still gonna have to spend 2 weeks, a really skilled person spending 2 weeks to figure out, is this actually going to win? I have to read all the documents, emails, whatever. And then at the end of the day, you can make, even if you double your money, you only make $50,000. We're a fund, we only keep, 20% of that, plus we got to pay everyone's salaries, keep the lights on, all those good things. So it's a hard, just fundamental business to put in place, but I guess, again, in theory, you could probably construct one that's uncorrelated.
Right, I think there's an underlying assumption here, one, that we're talking about commercial cases fairly uniformly across here and not consumer cases, which is very different, which also in some respects can deal with a single payer who may behave differently in down economic cycles. But I agree. I see the portfolio construction and strategy as very determinative of what sort of correlation there is. So Statera is that fund that is looking to service the sort of lesser middle market than a lot of other folks are looking at today, and that's not the $50,000 claims, but that's the $500,000 to $2 million investment needs. And so if you're dealing with only publicly traded companies and the most well-heeled of those, if you're dealing with existential claims against those companies, I would think you would see some behavioral reaction depending on what other stresses they have in the marketplace and how they deal with those claims, rather than if you're dealing with more routine pieces of litigation that have lesser damages in companies that are well-resourced but don't have the appetite to fight in a down economic cycle in different types of claims. So I think, if you're talking about antitrust cases, if you're talking, any of those cases that have existential damages or significant damages against a company, that's one consideration. But when you're dealing with commercial claims that might fall in a lower end of the market, you may see more predictive behavior that could track the economy better in settlement decisions and what they're willing to settle for.
How do we think about the kind of adverse selection issue that law firms are going to want to fund the good cases themselves, and what is left over is not necessarily kind of the cream of the crop? How do you kind of approach that, and how does it factor into your due diligence kind of decision making more broadly? Yeah,
and are there specific contractual arrangements you put in place so that you see all the deals, et cetera? Because obviously, as an economist, this is the first thing you worry about, that you're going to get all the lemons.
Yeah. Well, luckily, a lot of the structural impediments in the legal system and kind of carry over into law that created the need for litigation finance, also exist or carried over into the construction of law firms themselves. And so, there are law firms that regularly take cases on a contingency fee. They tend to be more geared towards class actions or mass torts. So, Bernstein Litowitz, my partner's former firm, they're a great securities class action firm. They take everything on a contingency fee. If they came to us and said, hey, we'd really like you to fund our case, we would run for the hills, because we'd say, why are you giving this one to us? You've got 500 cases over there that you've all equity in. But take a different firm like Latham & Watkins, for example. They're really not built to do contingency fee. Sullivan used to be a partner at Latham. You can probably attest. They probably only have a handful at most of cases on a contingency fee, and those are probably in, very special situations. So if Latham comes to us and says, hey, we want you to fund a case, we know that there's no adverse risk associated with it. And so you have to have a pretty good lay of the land of sort of what law firms will do, what types of cases, what their mix is, and understand why they're approaching you for each case. Because it's very hard, I can talk about this if it's interesting later, but it's very hard for law firms that aren't built to handle contingency fees to switch or dip a toe or do any of those things. And so we can feel pretty comfortable in those situations.
Right. We see the same thing. Your typical AmLaw 100 firms that are traditionally more defense firms are very different from these plaintiff side firms that are accustomed to doing things on the contingency. And this is, a huge part of the attraction of this space is all of a sudden now this solution lets that firm be competitive with their clients and new clients for all sorts of new opportunities. But, from my experience, these larger firms, if they carry, 2% of their WIP on their balance sheet at risk, that would be a big number. And obviously I'm just speaking arbitrarily, but they're constantly looking to move that off. And so they're very uncomfortable carrying risk. And so, contractually, you can engage the firm, and I think everybody would like to see the firm have some, skin in the game alongside the fund and the client. And so, I think you see adverse selection and you see negative consequences if you agree to fund 100% of the law firm's fees. If the firm has to put in, say, 25%, which for the case to be profitable, the representation to be profitable for the firm, it's got to have a favorable and efficient resolution, and all of a sudden everybody's aligned. And so you can structure it that way.
Looking at this kind of industry and asset as an economist, in addition to the adverse selection issue, what other kind of main questions would you have? Because it does almost look too good to be true.
Sure. So yeah, I got my PhD at University of Chicago, the efficient markets place. And so my thesis advisor was Gene Fama, who won the Nobel Prize for efficient markets. So, I suspect if he saw a graph of net returns with this kind of volatility being very low and this correlation, he would say it doesn't exist, A, or if it does exist, it's not going to exist for very long, right? And so my general take is it does exist. It's just how much assets can the space support? Because I'm, involved in firms that are related in not this exact space, but in this space, and they're all looking at this space. And so I could just say that those assets are going to come into this space with probability 1. And so then the question is, what happens? And typically when assets come into a space, net returns come down. And then all sorts of those other problems I mentioned about fund structuring and induced correlations, they all start to ramp up. And so the thing I would wonder is, where are we in that kind of life cycle? And are the players here, what's the runway they have to sort of extract these net returns, and how long can that last? It's not obvious to me where we are in that life cycle.
Yeah, I agree. And I think, it actually dovetails to me very nicely with some of the points we heard on the earlier panel, which is, how do we make sure that the consumers of litigation finance are getting a fair deal, things along those lines. And I think having an efficient market does that. I think it also drives down the returns, but that's okay. And I think everyone has the same question, which is, where are we in the life cycle? How long can this sort of utopia last? And I think that's.
Well, do you see pressure on? Do you see any people competing on the deals you want to get in? Have you seen that yet?
Yeah, absolutely. There's still not a lot. So what you have is it's so new. When I first started in this space, we'd call lawyers or we'd meet with lawyers, and we'd say, hey, we're doing litigation finance. We'd love to meet with you. And they'd say, what are you talking about? And or they'd say, sounds terrible. I want nothing to do with this. Or you take the words litigation and finance; they're the two ugliest words in the English language. You put them together, it's compounding. So, it was a very difficult place to start because no one had ever heard of it. You're going right into the teeth of the legal system. Lawyers are very conservative, so just getting your foot in the door was hard. Now there's a couple fairly well-established players, but I think a wave of education is taking place in the legal community and among companies, and they're all looking at this and going, this is a really great solution, and they're all pouring in much faster than capital can come in at the moment. So I think you're still seeing a very inefficient market. I think even though a lot of capital wants to come in, it's still hard to come in because you have to kind of establish proprietary channels for deal flow. Again, all of that will take care of itself over time, but I don't know how long that will take.
Yeah, just to echo, we're seeing the same thing. I think, and I'm new to this, so I didn't have those early conversations that Lee did. Our reaction of 18 months of having these conversations with law firms and CFOs and GCs, in institutions of various size, are that today most understand the concept. They understand litigation finance. They see it, daily or, at least weekly in their industry emails and publications. But after about 45 seconds, 99% of those lawyers can't hold a conversation past that and have yet to even think about how does this fit into my practice. And so, if you use that as a barometer, I think we're still very early in the adoption phase. I think, to Lee's point, I think there's been, some early entrants who have found very efficient use of the capital, but for the vast majority of potential recipients, it's still, trying to figure it out. So how far are we from this being, an efficient market? I think a lot of that depends on, sort of an educational approach. And how much of this, how long it takes for people to get comfortable and come on. And we're all lawyers, and the industry has grown up on effectively one delivery model in the commercial context, and that's the billable hour. And it's an attractive conversation to go to someone in a large law firm and say, you can be open for business with your clients on all of these cases, and you can effectively bring this business in that never was there before, and you will be compensated akin to the billable hour, so the firm will have no problem with what you're trying to do. It's a whole nother level for them to actually figure out how to do that. And so I think, you see slow ones and twos come in from these firms before, through one partner or two partners who are siloed before, there's any sort of efficiency within the firm and how they do this. So personally, I agree. I think there's far more capital right now interested than adoption will support. But, how large is this market is anyone's guess. We are talking about a legal industry that, whatever the number is, $292 billion, and you can splice it any which way you want. But a lot of what we're dealing with are the plus ones, right? So you have, folks bumping into each other in the economy that, could amount to a legal claim that is never brought because of, whatever historical bias there is in the system that didn't allow it. And so a lot of this is, what is the size of the market on the plus ones, and ultimately, once this is efficient, how big, is plaintiff side litigation in this country?
And to bring the discussion full circle before we open up for questions from the audience, it seems like this is a space that is getting more crowded, and we can discuss kind of at length how crowded it is and how much runway we have left. But what are the effects of kind of more crowding on the correlation with the underlying market? And would we expect, based on your anecdotal experience and your experience as an economist, would we expect more crowding to have any impact on the correlation with the market?
Yeah, we had a brief discussion of that. I think it's a bit different than in public markets where crowding leads directly to volatility and correlation. I think it's not obvious that channel here, if a bunch of people enter, would necessarily lead things to become more correlated, unless it's some of those things that I mentioned about the way redemptions and supply and demand on the LP side feed through. And if the asset class just becomes made up of more people that are funded in that way, then naturally that could cause that. I think the bigger effect is just probably on the net return, expected return kind of coming down. But I'd be interested to hear what you guys thought.
Yeah, I think I agree. I think it's more implicates returns than correlation.
Yeah.
The question I was interested in hearing from you guys also was about, some of the new, intermediaries that are coming up in this space, the online platforms, different ways that you can access this asset class, and do you view those as a threat? Just in thinking about this expected return maybe coming down, where do they fit in the spectrum of smart investors or not?
I think all of them are a little bit different. The one I know the best, I actually think they're really smart, and I think they're speaking tomorrow, is Jay Greenberg at Lectures. Some of these other platforms, I think, are probably more in the fintech space that don't really have any real sense of this asset class, except that it's getting great returns and people don't know how to get into it. So, hey, throw something on the wall and whatever, it's not my money type of mentality. But I also think, look, I think there's also a real need for something creative. You know, I'm a believer that this is ultimately a net good for society, and I think, you know, to the point before where I think the companies that have bigger claims, you know, they're sexier to folks like us and get more attention. But there's lots of people that call and I speak to, and I want them to have a resource because they are getting, you know, their mom and pop shop or maybe a little bigger, but not much, and you know they don't have any real way to bring a case. So I hope that there's a solution out there.
Yeah. Well, I mean that's why we're in business, to be sort of what everybody else isn't. Yeah, I don't see a threat from anybody, from the different structure or the different approach or the different size. I mean, I think that the threat comes from, you know, the folks in the industry, and you know, whether we're running a large commercial fund, or you know, an online, you know, platform like, you know, what you're asking. I mean, we see all sorts of different folks coming in right now, you know, many of whom have, you know, no legal training at all, which is fine, but have, you know, no understanding of the legal process. You know, you see investment bankers coming in on one-offs on these type of opportunities, and I think, you know, going to the last panel, you know, how, from a regulatory perspective, we sort all of these larger issues out will be very determinative of where this industry goes in this country. And so, you know, if there are bad experiences from folks who are ignoring some of the sort of controls that need to be in place in these opportunities, then that's probably the biggest threat that I see right now.
I'd love to open it up to questions from the audience. I think we have a mic that we can run if you just raise your hand, and then we'll make sure to come to you. Over there.
It's not really directly related to uncorrelated nature of the asset class, but someone mentioned the U.S. market at being $292 billion. Is that? I forget who said it. Someone said it, but
Somewhere there, right?
Yeah. What about the international market? What do you guys see the size of that market being for international, outside the U.S.?
Well,
Global legal services are addressable in this space, or? So just to clarify, you know, the 292 figure that I threw out is not what we see as the fundable size of the litigation market. I think 292, and I could have my numbers off right now, so forgive me if I'm wrong, but I think that's total spend in the U.S. legal market. But my point there was, you know, however you slice that, you know, it's there's too many unknowns to know how large this market is here in the U.S. I think, and I could be wrong, but that the global legal services market is somewhere right around 2x, twice the size of that the U.S. occupies about half the spend. And, you know, I'm not sure if you try and talk about how much of that is litigation, how much of that is addressable, you know, in jurisdictions where this is even a possibility, I'm not sure what that number is.
just to kind of look at it maybe a little bit different way. A lot of people throw out the legal services number. I don't think that's the best way to look at sort of our market, because you're paying someone to do the work. It's not sort of what the potential recoveries are, which is sort of where we are. So, you know, on that front, can't give you a great number, but I can throw out a bunch of random numbers and you can come up with what you think it is. So if you just look at breach of contract claims in the commercial, there's some court in New York called, I think, the commercial court. I think I'm going to mess up some of these numbers, but I think to get into that court, the amount in dispute has to be at least $50,000, and there's 70,000 cases a year, breach of contract cases, brought in New York commercial court. So that's one state court, and if you pin everything at the lowest number of 50,000, you're getting some big number. Multiply that by 50, also include federal court, probably not 50 because New York's bigger, but you kind of get where I'm going. You also have a lot of different sectors that are controlled by arbitration. So, basically every building that goes up, there's going to be contracts between all the various parties that are putting those buildings up, that any dispute has to go to arbitration. Well, there's tons of disputes that go up with every building. That's not going to even touch then you've got international trade disputes, which are, $20 billion a piece. The more creative you get, the more you think about it, the more you're going to unlock in terms of where there's value. Only a very small fraction of that is transacted on, thought of as litigation finance today. I don't know how or when we get there, but there's a lot of value that's fought over in this world, and it's probably a lot more than 300 billion. But I don't think anyone has a great handle on what that is.
Thank you. Anyone else? We'll get you a mic in just one sec then.
I'd like to just focus on the international question for a moment. We concentrate on international disputes because they're the future and the present of litigation, I think. And probably 60%, if you go by size of claim, probably 60 to 70% are international arbitrations and international litigations. So it's a huge part of the market and will only get more so as international arbitration spreads, as it's spreading all over the place in Hong Kong, Singapore, all over international arbitrations, especially against sovereigns. Huge cases, as Lee mentioned. So if you look at the size of the claims, it's a very large and growing part of the litigation market and also the funding market, I think.
So on that point, and back to the panelists, was there a question there, or?
There was a question about how much of the litigation, 200 and some odd billion in the U.S. was international, and that question, I think, is what I was addressing.
And oh, there's another question back there.
The question I have is about securitization. Where do you think we are in that process as we get new investors who want to eliminate idiosyncratic risk by investing in portfolios? Where are we? What needs to be? What are the pitfalls and challenges to getting? I look at this back in the securitization of mortgages back in the late 80s. Where do you see us moving, and what are the pitfalls to securitization?
Yeah, I'd love to hear their view on that too. I mean, every single asset class has the same life cycle where it starts with high returns, then a secondary market develops, it gets liquid, then securitization happens. It's just an inevitable process. It's happened in the loan market now, consumer lending, and it will happen here. And so, it requires a lot of standardization, and it requires a rating agency. So those are like two key components. And so, given the sort of heterogeneity involved here, I wonder about what you guys think about how long it will take until we get there.
I'll give it a shot. I think I know litigation finance pretty well. I don't know the evolution of securitization. Assuming that secondary markets is step one, I think we're still pretty far away. There are secondary markets, but they're not robust. I think there's one investment bank, and I could be wrong, that has a desk that transacts in litigation finance. I think for there to be a robust, and there's a couple other people who are dipping a toe. Maybe you see those other investment banks build out their practices, a couple more, and then you're kind of towards efficient secondary market. But I think we're still a couple turns away from even getting to that first step.
Do you view the secondary market as a buyer's market? Or is it just people selling?
It's a seller's market, yeah.
Okay.
I mean, again, because I think the returns are still so inefficient, I could
Yeah.
take, if I took any, took any one of our deals and put it on the market, I bet we could get a better, make some profit on it.
The securitization question is an excellent question. It's what any sort of investor will ultimately be wondering about where this asset class is going. I mean, it does feed back a little bit into the size of the asset class too.
Right.
If the asset class isn't that big, it's hard to imagine how big the securitization market could be. So it'd be interesting to sort of compare all the funds' pitch decks on how big they say the investable market is in terms of AUM. Yeah.
I've been hogging the mic. You can I'll go.
It's a good question. I haven't thought about that much. I see it through the lens as a relatively new entrant, the same way that Lee sees it, and that we're so new in, and that this is still so early in the development. And I don't know that I have a thoughtful response to that.
I mean, I don't feel any obligation to the development of the market. Personally, I try to do the best for our investors. I feel a lot of responsibility to them. They've entrusted us. But in terms of making the market go in any specific direction, leave it to somebody else.
This is for Lee specifically. So you've written kind of extensively about the accounting benefits of utilizing litigation finance as an in-house counsel or CFO. Do you want to talk a little bit about how that might be impacted by a potential economic pullback and how this might become a more appealing tool in that environment in regards to correlation?
Yeah. So I think, so I'm thinking about correlation. I'm thinking about we've put money in. Is the broader economic cycle going to impact how much money we get out or the timing of us getting it out? I think we are in a great place in terms of deal flow and our syncopation with the broader markets in that when the markets go down, we have, but I think that this is true for most investors too. I mean, I guess there's some, but then they're getting hit on the other side. So whereas I don't think we get hit on the downside of our returns when the market tanks, I do think we benefit in terms of deal flow and we see a lot more deals. Because the impacts of the businesses that would otherwise be paying those bills has been impacted. They no longer have those cash flows. We can step in. We have a dry powder, and we can help those companies. Also, I think a lot of what happens in good times is that people don't want to necessarily rock the boat with litigation or arbitration. People are more apt to kind of scrap for every last dollar when they're hurting. So I think a down economy helps us in that regard. And I think a down economy also kind of, I don't know what the saying is, but you kind of see who has their clothes on and who doesn't, right? And, I think a lot of bad actors get exposed when the economy tanks, Bernie Madoffs, other, maybe less nefarious schemes. But I think all of that comes to the fore. So I think, we will see, and again, this is hypothetical, but we will see good, great opportunity, better opportunities in those environments.
Could I just? I'm curious what you think. Logically, you could say that the substitution effect for a CFO in a down economy, all of a sudden these dormant assets, these litigation opportunities have more value than more productive value than other uses of their capital. Have you seen that at all in companies that are struggling, where they choose to shift and utilize what little capital they have to pursue these things because it's more productive than their alternatives?
Again, I'm sort of hypothesizing because I haven't lived through a down cycle as a litigation funder. But I also think it would be, I don't think that would happen simply because, the investors of those companies aren't going to care that they might get some great returns out of a litigation. One of the great uses of our capital is for companies that need to report their earnings or show investors, they can take their $10 million and invest in a litigation or invest it in, whatever they do, make light bulbs. If they invested in a litigation and they get a 10x return, the investor's going to go, so what? You can never do that again. Whereas if you take that $10 million and put it into the building of light bulbs and you get a 20% IRR, those investors go, wow, this is great. You're beating the market. We can build a whole business on top of it. So I think even in those scenarios, a CFO is probably going to be more incentivized to invest in a company than to invest in a one-off litigation that might give them more cash but give their company less legs.
I mean, to Mr. Seidel's point earlier, we had this discussion about how there are different types of litigation finance, and all of this has been kind of focused on commercial litigation finance. But I wonder how you view the other types. I mean, we have the retail side of it, and then there's the arbitration financing. There's a whole world out there. How do you view the returns and also the volatility of those asset classes? Are they comparable to the kind of vanilla commercial stuff we've been talking about, or are they different in significant ways?
And also, what's the size of that market too? This, in some sense, relates back to the securitization question too. Consumer lending took off, and then securitization followed behind it, largely because those were sort of smaller loans, and then there just were billions of those smaller loans. And so, is there a path where the market goes down market to smaller claims that are more easily processed, and a technology solution can come in and scale that market up? Then you could sort of see that natural evolution to securitization. I just don't know how big that market is. I'm interested to hear.
I agree completely. I think in consumer claims, it's a very different business, and I think it's one that lends itself well to securitization. It's much more actuarial in nature. So the way that a consumer litigation finance business would work is someone breaks their arm and their insurance, in a car accident, their insurance company won't pay. They call up, Peachtree or whatever it is, and they say, can you advance, I've been out of work for a month, my insurance won't pay, can you advance me some funds? And there it's, okay, well, it's a broken arm, it's a car accident, it's in this jurisdiction, it's State Farm or whoever it is, and therefore it has a 52.7% probability of paying this amount of money, and they've got all the data and they process it. So I think, one, it is a different business. I mean, we're doing deep dives, looking, using professionals with extraordinary skill to understand the nuance of a case. There, they're just looking at buckets and finding a statistical probability and relying on the law of large numbers. But to do that, they're getting thousands and thousands of cases. Our cases don't exist in those numbers, at least as we haven't been able to find them yet. And it also, turns on becoming a marketing exercise. You got to run ads on Maury Povich show, and you have to have the capital to all those, right? So we're not doing any of that. So it's a very different business, but I think it is one that is, deeper, larger, and lends itself to securitization.
Yeah, I agree. I'd see, far more predictability and less volatility across economic cycles in those types of cases. Although I agree, I think as we come to the net of it all, I think, the consensus of the panel is there's low correlation in the commercial, sector as well, and perhaps, negative correlation as filings go up and our capital becomes more attractive. But I don't see much volatility in the arbitration space that differs much from the larger commercial space. I think there's efficiencies in arbitration, timing, and other procedural efficiencies that reduce some of the risk. The idiosyncratic risk that's in cases filed before tribunals, other tribunals, courts. But ultimately, I think the determinative factors are fairly consistent across, and that's settlement and execution.
It seems like one important question to answer, and it's kind of come up a bunch of times, is how big this market actually is. And so I don't think we have the answer, but I'd be curious to know, kind of between an economist and two practitioners, how would we go about sizing the market? Where would we start? Kind of where would we end? Just curious to hear your thoughts.
You know, I mean, I think they give good, I mean, looking at the volume of claims is where you want to go, I think. But then you made some good points about it's sort of a tip of the iceberg phenomenon where you don't observe a lot of things as well, which could make the market size a bit bigger as well. So, I mean, this is the big question that everyone who's trying to invest in this space, by the way, is also looking at things like life settlements, which are life insurance policies that are sort of have an idiosyncratic component. A lot of people in this, investors looking at this will also look at like things like catastrophe insurance that I mentioned, sort of a lot of these asset classes that have the same feel of a kind of a random timing of the outcome, where you could put some expertise on it and get a high net return. And this is the question that's asked in each and every one of those asset classes, is just like, how big can it be? And the number is always much smaller than what the fund managers say. But, you know, I think they give good answers why maybe, you know, maybe there just hasn't been enough entry yet. And so for these guys, there's quite a bit left. For the masses at large, there's no way you could put trillions into this, but.
Yeah.
I mean, also you need someone who's willing to trade. I mean, that's the other thing. I think there's so to your point is returns will come down because more people will enter the space, and then more people will be willing to trade, and that will increase the size of the space. You know, so, you know, what's the size of the market at the returns that we're seeing right now? It's however much all the funders are putting to work. But I do think I think this will look more like Walmart and less like Tiffany's at some point, where there's lots and lots of transactions happening at lower margins. And again, if you just think about, you know, if when people always say, when should we think about litigation finance? And I always say, you should always think about litigation finance because you don't know what the terms are. If I'm willing to lend you money at 1% for your claim, you should always transact, right? I mean, that's a great bargain for you. So, you know, if returns come down to a place where it's very efficient for people to transact, you know, again, how much is disputed in the world? You know, we're probably talking about maybe close to $1 trillion. I don't know. But I think that it's so tied to returns that and you're talking about only what will we transact on. So.
Yeah, I agree. I mean, I think those are two important different ways of looking at it. Is you know how much capital ultimately could be put to work, and then you know how much are funders willing to actually put to work, and you know when does it become less attractive? But you know one challenge we have obviously is lack of access to data. And so, you know, there's no cohesive that I know of, you know, system to, you know, look at federal data, state data, and combine it all and see, like Lee talks about one court in the state of New York. You can go on Lex Machina and look at, you know, predictive federal case, you know, statistics over time. But, you know, there's inefficiencies in the data that we look at. And I also, you know, and with Lee, I'm a firm believer in sort of the value add and utility of this, and this is an access to justice solution. This is, you know, an opportunity to pursue a meritorious case where that didn't exist before. And so how big is that world? I mean, we do not, to my knowledge, have any, you know, understanding of again, those bumps that occur in the marketplace that, you know, never see the light of day, that perhaps should. And perhaps this is a solution that turns those on, and I'm not sure how you go about that. It'd be an interesting paper.
A good way to try to get at that number is to, from an investor's point of view, is to ask funds how quickly they're deploying their capital, and you can get a sense if it's taking a long time to deploy the capital, then it's hard to find maybe enough opportunities.
Yeah. And I think it's hard. I mean, I think it's hard to find opportunities. I think that's the name of the game. I think it's all about accessing deal flow. But you know, what does that look like 50 years from now? I don't know.
Right. And I think, you know, and this might be naive on my part, but the assumption in that is that you're dealing with a consumer base that is educated and familiar with the solution, and they are making decisions based on a knowledge of what's available to them. And I think we still live in a time where the vast majority of folks do not either know of this or view this as any sort of solution. So it's not that they're choosing against this, and so capital is not being deployed, for some educated reason, but it's just, still in evolution.
I think we had a question over there.
No, I was just going to say, Lee, a question to you in terms of corporations, talking about when's that time where they're going to really embrace litigation finance. Do you see that being embraced in a portfolio concept way, or is it in case? And where do you think we are in terms of that?
Yeah, I think we're starting to see it embraced in both. I think we're very early in that adoption. I think we've done a couple transactions with household name companies where we're their litigation funder. I suspect Burford's done a few more, but I still think but it's all been kind of happening very recently in the last year or two. And I think you're going to see a lot more of I think that's going to be one of the biggest next trends is, those companies realizing that this is a better way to fund their litigation. So we're just at the very beginning.
Are there any other questions from the audience? Yes.
So y'all have mentioned the reluctance of the large firms to either do contingency or to kind of switch over to be able to be more receptive to litigation finance. I think you said they're not built for it. Is that general conservatism? Is that their financial structure? And what would need to happen for them to be more receptive?
I think they're receptive to litigation finance, or they're becoming receptive to litigation finance. But I think that the issue is them taking on contingency fees. And I think the issue there is that it requires a lot of trust among the partners if they haven't been built that way from the beginning, which is to say, you have a large firm, they have 25 offices across America, and they have compensation structures that are based on the billable hours. So Mary in New York is a litigator, and her client tells her she has a great case, and Mary wants to take on a contingency fee. And then there's a transactional lawyer in Los Angeles who, that person's isn't proposing that he does any work on a contingency fee. They both have contracts with their law firm to pay them $3 million a year. So how does Mary go to her other partner in LA and say, hey, I'm not going to collect any money for this firm for the next 5 years, but it's okay, because in 5 years, I'm gonna bring in $25 million because we're gonna win this huge case. Well, the lawyer in LA has never met Mary before. She doesn't know anything about this case, doesn't know anything about this client. So why would the LA partner want that to happen? And so, that's one of the fundamental issues. The other issue is that, I think this was raised on the last panel, is that law firms can't raise equity. So unlike every other company in America, they can't capitalize opportunity and mitigate risk in the same way. If that case that Mary brings loses, they're just out all the money that she would have lost. and you effectively just took money out of everyone in the firm's pockets, which is just, no other business operates that way. So there's some fundamental structural issues that make it really hard. Some firms dip a toe in, like Kirkland and Ellis. And then there's some firms that, have really gone all out, Sussman Godfrey, Quinn Emanuel. But it's hard, and I think lawyers are conservative in nature, and I think it's going to be a long time before that happens. I think the biggest thing that could happen to bring that into reality is to relax the rules on who can own law firms. And I think that would change everything overnight.
So, and just to go one step further, I think every jurisdiction in the country except for D.C. Has a prohibition on outside parties having any sort of interest. So, I agree 100%. I think Lee nailed it on both points. I mean, you have limited access to capital. The capital you can generate, comes from the partnership, or, it's some sort of outside debt financing that's going to bring those cases. And on very large, expensive cases that cross, years, these are cash-based businesses that, close out their books every calendar end. It just doesn't fit. And so then when you get to these larger firms, Lee's exactly right, and I live this world, everything is based on the hour as a result of that. And that's why the hourly metric exists. And you cannot let 995 lawyers be evaluated and compensated every year based on one metric, their productivity based on a number of hours, and let 5 partners go out and run a risk practice. It just does not work. And so firms have shied away from it. Everything is on the hour, and I think that's why you see companies who typically use those firms less reluctant to pursue affirmative litigation, because they traditionally, with their partner firms, would have to pay on the hour for that, and there's no budget room for that. And so those cases, unless they need to be brought, typically go to die. So I think that's a lot of the inefficiency and why this space exists.
There's a question in the back there.
So let me ask the hard question then. Are there enough lawyers for all the capital that wants to be invested in? I know it's a bit ironic. U.S. has too many lawyers probably, or not, who knows? But clearly more than other countries.
Apparently there's not enough funds, which is
But-
amazing to me,
so
teaching
the thing
investment
is-
management.
If tomorrow all the capital that is interested in litigation finance were to come in, do we have enough lawyers to say, well, we have enough cases? And if that were to be the case, well, if they could put on the hours to work on these cases, does it mean right now that most of the time they're not working?
I'll give it a shot. No, I think we've got plenty of lawyers. I think the issue isn't that there's not enough lawyers and not enough cases being brought. I think on the margins, maybe this would increase the amount of cases being brought. I think what it does is it allows companies that otherwise wouldn't be able to access certain lawyers the ability to access those lawyers. So that's as far as I can go.
I think if you ask a lot of large firms, there's hours in the day that their lawyers aren't occupied, and that means there's capacity. If they're not at 24 hours a day, there's capacity in the space. So
Yeah.
I think there's enough lawyers.
Yeah.
So you're telling me essentially that the money right now is going to pay for very, very costly hours of lawyers that right now are not being used.
Yeah, you're cycling up the
Yeah.
food chain, yeah.
That works. Okay. Yeah, okay. So actually that also means that they could, yeah, well, anyway, thanks.
I understand what you're saying. I don't have a great, I think, from an economic standpoint, what you're saying would make sense, but I don't have the sense that there's plenty of lawyers. There's not enough good cases, I'd say, is the issue.
I
Not
say
enough
this
lawyers
because
who have realized the value of a 2 and 20 fund structure, which a certain few here have, and hopefully many more.
the reason why I asked the question is because both of you said that it was hard to get the lawyers to say, oh, I'm going to buy into this litigation finance way of modulus operandi. Some of them say, I'm going to stick to what I do. You say they're very conservative. But if this enables them to take more business, they should go for it.
Yeah, and I think you'll get that. I mean, one of the most common questions I hear, as you explain this concept to folks unfamiliar with it, is why now, right? So why did this, come about in the UK and Australia, 20 years ago, and why did it take so long for it to come to the United States? And I don't have a very good answer for that, and I still, of all the times I've been asked, I still don't have one, other than I do think that our system is so embedded in this one delivery model, and that structurally change takes time to bring about. And I think we're still, to my point earlier, we're very, very, very early in the adoption cycle. And I think if you look at, I think Lee, and this is the first time I'm meeting Lee, but I've read Lee's material and his partner's material since the first day I looked at the space. I think they've done a tremendous job with putting a lot of, really substantive thought leadership out there. I think a lot of the capital that's deployed in the space has been done more passively. I think some of the larger funds are out there publishing a lot to educate. But as you go out, which I've done, over the last 18 months, and try to go to these markets that don't have funder presence, and if you look at a map and you map out where everybody is, it won't take you very long to do that, and you'll see heavy geographic concentrations in Chicago, New York, and ringing the coasts of the cities you'd expect to see, but large geographic holes. And when you go talk with lawyers in those cities, again, they're familiar with it, but not nearly to a point where they're comfortable approaching their clients. And so, I hate to use the word sales, but I think, for this to grow inside a firm, it's very much more of a sales than marketing process, where, and I don't think that's the right, way to describe this, but what I mean by that is you need to hold lawyers' hands to get them to change the way they've traditionally had a relationship with their client. And I don't think this changes the relationship at all, but there's some fear of that still. And when we go into these other markets, and we are the first live conversation that large firms have ever had with anybody hovering in this space over and over and over again, I think you realize that there's it's just still very early on.
Southeast is like 10 years ago.
Where do you see the largest growth in the total market? Do you see it with the traditional undercapitalized client, or do you see it with the blue chips using it as a corporate finance tool? Do you think, traditionally speaking, it's easy to explain the David versus Goliath model to anyone in a couple minutes. I think generally that's the entry point of how you get a firm on board. It's a quick, easy case study. But as far as total dollars in the market, do you think that blue chip example is, I know we're early on, but do you think that that's going to be the largest market growth leader?
Yeah, the largest, I don't know. We really like that. I hope it's the largest for us, because those companies have often invested, significantly in whatever dispute that they're engaging in, which from a liability and damages perspective is often helpful. So we really like it. It's hard to know whether, a handful of blue chip companies and all their litigation on the one hand is more than everybody else. I don't know the answer, but I think you'll see, if this market develops in the way that people are anticipating, where it's, somewhat ubiquitous and somewhat efficient, you'll have different players operating in different tiers and scopes and carving out their niche, and I hope that's our niche. But I think there's going to be significant growth in that. I think that there's virtually none of those companies using it now. I fully believe that a lot of those companies will use it in the future. I just don't know how to weight anything more than that.
Yeah, I think it also, to Lee's point, I think it depends on how, our market approaches those folks. And so if growth today through some of these larger funds is more portfolio-based and single-case, based, then, I think there's more potentially attractive single cases, at a smaller dollar threshold. But that's not really what most folks are doing today. There are plenty of folks in the space doing that, but if you talk about some of these larger funds, they're trying to deploy larger portfolios to the blue chips. And so I think there's an adoption where folks will still want to have test cases, and these will play out. There's a short-term, test case where this will develop before that really develops on a larger scale. But I agree, it's the future.
Well, if there are no more questions, I'd like to thank our panelists. I think we tried to explore an interesting topic here, and I think that we looked at, areas where, like you said, it would be an interesting place to do research. So I'm glad that we were able to kind of push up against the cutting edge, and I thank the audience for participating.